Hello everyone, Namaste. Today I'm introducing you a very special topic of macroeconomics, Unit 10, National Income Accounting. Meaning of national income. National income is the flow of final goods and services available to a nation during a year. It is the flow. Be very careful. It is the calculation of the flow of final goods and services available to a nation during 1 year time period. The aggregates of money value of final goods and services produced within a territorial boundary of a country during 1 year time period is called national income. This is the definition of national income. This is the aggregates addition of all the goods and services produced within a year under a territorial boundary of a country, and the calculating the money value of all these goods and services and taking the aggregates of all these money value in 1 year time period is called national income. Similarly, the aggregates of goods and services produced in a year by utilizing its resources is called national income. So goods and services produced in a year that must be produced by utilizing the domestic resources. Okay, and the money value of all the domestically produced goods and services is called national income. Some definitions of national income. Gardner Eccles has defined national income that the macroeconomic concept of national income is the sum of all individual incomes. It is the sum of wages, salaries, and commissions, bonuses, and other forms of employee earning, net income from rental and royalties, interest income, and profit that come under the national income. Alfred Marshall Alfred Marshall has defined the labor and capital of a country acting upon its natural resources produce annually a certain net aggregates of goods and services that is called national income. In order to understand the concept of national income accurately, one need to understand the flow of national income. So this is the flow. We do not take the stock of goods and services produced. Only the flow will be accounted in calculating national income. So national income is a flow concept. A person's income is the expenditure of other person for exchanging goods and services. You have to remember, if one person gets some money income, that is definitely the expenditure of the another person. If another person gives you, then it will be your money income. So the threefold identity has to be considered while understanding the next income. That is y, that is the money income, must be equal to E, that is the expenditure, that must be equal to O. This is the total goods and services produced. So the value of Y income side, that must be equal to the money spent value of E, and that must be equal to total goods produced output. Okay, so more clearly, if you go to the market to buy sugar, let's suppose, if you buy sugar worth 100 rupees, it means you spend 100 rupees, that is your expenditure. Your expenditure 100 rupees is the income of the businessman, shopkeeper. So 100 rupees is the income of businessman, and it is your expenditure. And the sugar, the market value of sugar must be worth 100 rupees. That is the output. So all must be same. value of Y must be equal to value of E, that must be equal to value of O. The different concepts of net income. The concept of net income implies the modes of net income. Different modes of net income that we that we understand the net income differently in different circumstances in different countries. More clearly, concepts of net income is understood as the various names of net income given to it by modifying the core value of aggregates of income, expenditure, and output. There are various concepts of net income as per the practice of accounting in it in the particular country, such as gross domestic product (GDP). World Bank defines GDP as GDP measures the total output of goods and services for final use produced by residents and non-residents regardless of the allocation of domestic and foreign claims. It is calculated without making deduction for depreciation of assets or depletion and degradation of natural resources. This is the definition of GDP given to definition of GDP given by World Bank. Okay. So here GDP at market price. The market price GDP of the final goods and services, that the price of final goods and services, that is called market price, is equal to C, goods for consumption, I, that is the value of goods for consumption, I, that is the investment value, GDP at the market price is equal to C, total money spent by consumer household sector, and this I, total money spent by business community for investment, and G, total money spent by the government. Okay, so the value of C, I, G is called GDP at market price. So here GDP at factor cost. So the market price is not equal to factor cost. Okay, when we add some value, some addition, some subtraction, on the market price, GDP at market price, we get to GDP at factor cost. For example, GDP at factor cost is equal to GDP at market price plus, here we add subsidies, and here we deduct indirect taxes, because the goods that arrive in the market finally is added the subsidies, subsidy is deducted and direct tax is added in the market. So to come to the factor cost, we add the subsidies and we deduct indirect taxes. So when we add subsidies at the market price, GDP at market price, and when we deduct indirect taxes to GDP at market price, we get to GDP at factor cost. Now, net domestic product, NDP, market price, net domestic product. In order to calculate net domestic product, here we deduct the depreciation from the GDP at market price. So GDP at market price, here we get GDP at market price. GDP at market price minus depreciation is called net domestic product, NDP at market price. Gross national product, GNP. GNP at market price, that is equal to GDP at market price plus net income from abroad, which is written as X minus M. Net foreign income, you can say net foreign income from abroad, or net income from abroad, that's all right, X minus M. Okay, and this is called gross national product, GNP at market price. So in order to calculate GNP at market price, what do we do? GDP at market price plus net income from abroad. Okay, here this is number one. We can say number one, GDP at market price equal to C plus IG, C plus I plus G, and GDP at factor cost equal to GDP at market price plus subsidies minus indirect taxes. Okay, here GNP at market price is equal to GDP plus net income from abroad. Now GNP at factor cost is equal to GDP at factor cost. Okay, GDP at factor cost is equal to GNP at factor cost. Sorry, GNP at factor cost equal to, here is GDP at factor cost. Here is GDP at factor cost. GDP at factor cost plus X minus M, net foreign income from abroad. Okay, so if you have to find factor cost, you get to GDP at factor cost, and if you have to find market price, then you go to this GNP at market price, where net income from abroad is added to GDP at market price, and net national product NNP at market price. NNP at market price is equal to GNP at market price. You can see here GNP at market price. The value of GNP at market price is calculated by this method. GNP at market price minus depreciation, we get to GNP at market price minus depreciation is equal to NNP at market price. And now NNP at factor cost, NNP at factor cost is equal to NNP at okay, NNP at factor cost is equal to NNP at market price minus indirect taxes plus subsidies. NNP at market price factor cost is equal to NNP at market price minus indirect taxes plus subsidies. So when we deduct indirect tax and add subsidies to NNP at market price, this value NNP at market price, we get to NNP at factor cost. And now national income ENI. So the value of NNP at factor cost is equal to ENI. Okay, this is called national income NNP at factor cost, which is calculated NNP at factor cost, NNP at market price minus IT plus subsidies. Personal income PI, personal income. This is the core value of the factor income. You can say personal income, which is calculated NI. This is national income NI minus CIT. Okay, corporate income tax, and this UCPT, undistributed corporate profit tax, minus social security contribution plus transfer payment. Okay, when we deduct corporate income tax, undistributed corporate profit, and social security contribution from ENI and add transfer payment, that we get to PI, which is total factor income. You can say income of the household sector, net income of household sector, we get to this. Okay, because when the factor has contributed to produce goods and services originally, before it reaches to the market, there are so many additions and modifications on that core value of the factor produced, goods produced, that is the factor income. There are so many things are added, like indirect taxes and that are subtracted, like transfer, that are subsidies and depreciation and different types of net factor incomes. So there are so many modifications on that core value of the product. So in order to arrive to that core value, now we need to subtract all these values that has been included, like CIT, consumer corporate income tax, because you have to pay corporate income tax to the government when it goes to the market. The firm has to pay certain amount of tax to the government out of the profit, that is the corporate income tax, undistributed corporate profit, and some fund, some money had to be separated for the shareholder, you can say, that money which is added on the goods produced, so that must be subtracted finally. And social security contribution, and this is also value which is separated some money as a fund to compensate some uh, unavoidable expenses of the firm, like meeting the accident cases and other. So, and some donations and some contribution in the society through that fund. That fund is created, some value of the fund will be subtracted to get to the net value of the factor. Okay, so NI minus CIT minus UCPT minus Social Security SSC and transfer payment, that is the value which household sector get without making some physical effort or mental effort. Okay, like government provides some fund, some assistances to the special group in a society, like old age group, like orphan, like handicap, like pensioner, retired personnel. So these funds are to be added to get to the real value of household sector's income, which is also called PI, personal income. Okay, and now disposable income, DI, is equal to PI minus direct taxes, because if household sector get some money, some fund, and from there direct taxes have to be deducted to get to the disposable income, because the contribution they should make to the government. Okay, personal income, per capita income, per capita income, PCI, equal to national income of a particular year, that is, you can say GDP or GNP, whatever is there in the practice of the particular country, is divided by population in that year, in that particular year. So existing population will be numerator, denominator of the GDP of the current year. So these all are the concepts of various concepts of national incomes. Okay, and now circular flow of national income. Here, how the national income flows from one sector to another sector. Just you see, this is household sector and this is business sector. Okay, business sector, business sector uh, business sector provides, household sector provides uh, labor, land, capital, enterprises to the business sector. It means household sector supplies land, labor, capital, and enterprise or management to business sector or firms. For that, okay, this household sector provides services worth some due contribution, which is paid back by the household sector in terms of wages, rent, interest, and profit. This is called factor payment. Okay, the money that is paid by the business sector to household sector for the contribution it made to produce goods and services. Okay, so factor goes here, and due contribution of those factor is given to household sector by business sector. Okay, and the money what is received by the household sector from the business sector, for example 100 billion, you can say 100 billion is received by the household sector from the business sector uh, due to its contribution in the factor supply, like land, labor, capital, and management. So 100 billion is the income of the 100 billion is the income of household sector, and 100 billion, suppose this is the expenditure of household sector. So household sector spends 100 billion, and business sector spends 100 billion, and household sector receives 100 billion. Okay, when household sector receives 100 billion, that money what household sector receives does not uh, stay there, you can say. It is a flow, so that will be spent for the purchase of goods and services. Okay, so household sector will get the goods and services. Look here, flow of goods and services worth 100 billion, and that money is given to business community. That 100 billion goes to this business community, and in return good worth 100 billion go to household sector. So here we can say the amount 100 billion is the income of household sector, and 100 billion is the expenditure of business sector in upper segment of this flow chart. Okay, and finally that income of 100 household sector 100 billion will be spent by the household sector for the purchase of goods and services, because goods and services are produced for the consumption. So we will consume, finally household sector will consume the goods and services. So 100 billion, that is whole received, we can say received by household sector will go to business sector. So 100 billion is received by business sector. Finally what it paid to the household sector for the purchase of services, different services. By using the services, it has produced the goods and services. Okay, and for the due contribution 100 billion has been paid by the business sector to the household sector, and that household sector spend that 100 billion for the purchase of goods and services. So household sector it spends 100 billion for the purchase of goods and services, and business sector spends 100 billion for the purchase of factors, factor of productions, factor. Okay, so this is the circular flow of national income of two-sector economy. Similarly, three-sector economy, when government is included in the flow, that becomes three-sector economy. You can say similar as household sector and business sector. This is the two-sector economy that we have discussed in the previous slide. And now some money, household sector, whatever amount is received by the household sector by selling services, different services, you know, uh, land labor capital organization. In return, in terms of wages, rent, interest, and profit, household sector got money. That money will be divided in two parts. One, some money go to the government treasury in the name of tax payment. Okay, so money received by household sector goes to government treasury in terms of tax. Okay, and some money goes to okay some money goes to the business sector for the purchase of goods and services, and the remaining money will be saved. That's shaped. Okay, and here the money saved by the household sector will go to business community in the name of investment through the financial market. There is financial market, banking institutions. The saving made by the household sector through the banking sector, financial market, will be converted into investment, and again that will be used for the production of goods and services. Okay, so money received by the household sector will be divided into three parts, three flows. One is consumption expenditure. Some money go to huge amount of money go to this purpose, and some money goes to government treasury in terms of tax payment, and some money goes to financial market in terms of saving. Financial market gives loan for the investment to the business sector. Here money money earned by the business community from the household sector, entire money earned by the business community from the household sector, and even the it means business sector will sell goods and services to the household sector, and business sector and business sector gets money from the household sector, and business sector sells goods and services to the government, and in return government pays money to the business sector. So the income of business sector is flow arrived from these two sides, one from the household side and next from the government side. And the total income of the business sector will be spent in two purposes: for the payment of factory incomes and the payment of tax to the government. So government's income will be collected from two sides, from the household sector's income in terms of tax and business sector's income in terms of tax, corporate profit tax and corporate tax. Okay, so the money received by the government will be spent again for the purchase of goods and services from the business sector, and money will be spent to the public in terms of services that the government receives, that wages and salary for the government personnel that come from the household sector. So wages and salary is paid by the government to household sector. So household sector's income is also made from the two sides, you can say, from the business sector and from the government sector. Okay, and that income will be spent for the consumption of goods and services, and tax payment to the government, and saving. That money, saved money through the financial market, is converted into investment that will be used by the business community to produce goods and services, and money will be earned by the business community from selling goods and services to household sector and selling goods and services to government, and money will be received from the government and household sector, and that money will be channelized to household sector back, and some money will be paid in terms of corporate tax and profit tax. Okay, so this is the circle flow of national income with government activities, you can say. Now, real and nominal GDP. The nominal GDP is the value of all final goods and services that an economy produced during a given year. That is a nominal value, that is the amount which is calculated uh, by adding the market, converting the produced goods with the market price. Okay, that is the nominal GDP. It is calculated by using the prices that are current in the year in which the output is produced. So that is arrived that nominal GDP is calculated by using the current prices, current market prices. In economics, a nominal value is expressed in money terms. So nominal value, nominal GDP is always expressed in money terms. Real GDP. The real GDP is the total value of all of the final goods and services that an economy produces during a given year, accounting for inflation. So it is calculated using the prices of selected base year. To calculate a real GDP, you must determine how much GDP has been changed by inflation since the base year and divide out the inflation each year. Real GDP therefore accounts for the fact that if prices change but output does not, nominal GDP would change. So here, real GDP shows the real value added in the economy. I would like to give you one example. Suppose a farmer produces 1 quintals of orange that cost 2000 rupees, for example. Suppose that is the GDP. 2000 is the GDP this year. And next year, if the price of orange has increased to 3000, it means 1 quintal, same amount is produced, 1 quintal of orange is produced, but that farmer received 3000. It means GDP became 3000. Okay, here increase in the value from 2000 to 3000 is called nominal GDP. That does not show the real change in value add, because the farmer has produced 1 quintal previous year, okay, this year and the next year. It will produce the same amount of orange. There is no extra output in the society. Only due to fluctuation in the market price from 2000 to 3000, 1000 has been added. That does not show the real value added in the community. So in order to avoid this confusion, we calculate real GDP. In order to calculate real GDP, we need to get one base year, which is very normal year. That base year's price will be the basis of calculating real GDP. Okay, suppose this year the price of orange is 2000 and the next year price of orange is 3000. In order to calculate the real GDP, we we take the base of the price of orange, this year's price 2000, not coming year's price. Okay, it means this year 1 quintal is produced and next year also 1 quintal is produced, no additional output is found, then there is no addition on the GDP, there is zero growth. Okay, so in this way we take the value of inflation in order to account the value of real GDP. So real GDP therefore accounts for the fact that if prices change but output does not, nominal GDP would change. Only nominal GDP would change, but real GDP may not change. So that must be accounted. Okay. So the GDP deflator. The GDP deflator is a price index that measures inflation or deflation in an economy by calculating a ratio of nominal GDP to real GDP. Okay, so in order to avoid the fluctuation in the prices and get the real contribution, real value added in the economy, we need to take the help of GDP deflator. Okay, the GDP deflator is a measure of price inflation. It is calculated by dividing nominal GDP by real GDP and then multiplying by 100 based on the formula. So if we divide nominal GDP by real GDP and that coefficient will be multiplied by the 100, that is the GDP deflator. Trend in the GDP deflator are similar to changes in the consumer price index, which is different way of measuring inflation. So next is consumer price index. This also helps to get the real GDP value. So here is the formula. Calculation of GDP deflator. GDP deflator is nominal GDP upon real GDP into 100. Computation of national income. So how do we calculate national income? There are different approaches. There are three approaches, basically income approach. National income is calculated by adding the income of all individuals or factors in a country. It includes income. So all the incomes, okay, received by the household sector will be added to get to national income from the income approach. So here, income earned from the wages, salaries, and allowances, income in terms of rent, in terms of interest. All the values will be added that goes to the hand of household sector. That aggregate all these value of aggregates of all these value will be same as the national income. And here next is wages, salary allowances, rent, interest, corporate profit tax. The money received by the household sector in terms of corporate profit after deduction on the undistributed corporate profit, social security contribution, and so on. So money remnant amount what an individual gets in terms of corporate profit, that is also income of the household sector. So corporate profit, profit tax, dividend, and undistributed profit. Okay. Income from self-employed. A person earns money on his own. That is also income of the household sector. And indirect taxes. A person contributes taxes to the government, indirect taxes to the government. That also will be added to the income side of the national income. The total of all these headings will be called as GDI, gross domestic income. So in order to arrive at GDI, we have to add this. Okay. Now we get GDI. Now GNI, gross national income, is equal to GDI plus, this is GDI, and GDI plus net income from abroad. When we add net income from abroad, that is x minus 1 in the previous slide, that we go to GNI is equal to GDI plus net income from abroad. Okay, and now NNI is equal to GNI minus depreciation. When we deduct depreciation, wear and tear of the forms, machineries, building, and fixed factors that we say, that is called depreciation. So when we deduct GNI, depreciation from GNI, we get to NNI. So what we exclude from national income, sales of building, automobiles, or any other goods produced in an earlier time period. So we do not add these receipts in the national income. Okay, because these are the asset, you know formed by previous incomes. So we do not add to the current year's net income sales of building, because building has been constructed from the earning of the many years. So we cannot include the earning of the current years. So this will be excluded. Building, automobiles, or any other goods produced in an earlier time period. Sales of stock and bond. We do not include sales of stock, because stock and bond shares, we do not include the money received from this stock and bond. Income from government transfer. Government transfer will not be accounted in the income side, because this is the money contributed by the government to the particular community of the society, okay, without any physical or mental effort. And interpersonal transfer. So a person pays to another person as a gift or some money with mercy or some contribution. That money will not be added to the national income. So this should be excluded from national income accounting. Expenditure approach. National expenditure is calculated by adding all the expenditures made by individuals, business, and government on goods and services during a year. So all the expenditures made by individuals or household sector, business sector, and government sector. If all sectors expenditure are added, that is GDE. Okay, GDE is derived. It includes private consumption expenditure, which is denoted as C, gross domestic private investment of business sector, denoted as I, and government expenditure on goods and services, denoted as G. Okay, all the expenditure. So GD is equal to C plus I plus G, and G and I equal to this C plus I plus G. It means GDE plus net income from abroad, and N and I is equal to GNI minus depreciation. So what we exclude while calculating NNI or net income from expenditure method? What we exclude? We exclude changes in ownership of pre-existing output as they are not part of the total expenditure that measures the value of current output. Changes in the owners of pre-existing. So owners of pre-existing output, okay, will not be included in this expenditure side because they are not the part of the total expenditure that measure the value of current output. That is not the contribution of the previous years or current year's output. That has been changes in the owners. One person has purchased the land or building or some machineries, and that ownership has been changed. That is not the output of the current year. Okay, that will not be included. Sales and purchase of the bonds and stock, that will not included, and transfer payment from the government, that will not be included. So this will be excluded from this expenditure method of calculating national income. And output approach. There are two methods of calculating output approach. Final product method. The price of intermediate goods, the value of goods produced previous year, and price for the machine equipment imported are to be adjusted to find out the actual value of GDP. Okay, output method. So final goods and services, the price of final goods and services will be accounted to calculate national income from the output method. And in addition to this, price of intermediate goods, okay, intermediate goods uh, like input you can say will be included, like raw materials you can say, value of goods produced previous year and price for the machine, that will be included. Equipment imported are to be adjusted to find out the actual value of GDP. The value added method. Here, under the output method, final goods and services will be accounted. In order to calculate the value of final goods and services, these components are to be considered. Okay. The value added method. The difference between the value of output and the value of input is called value added. Value added is the real contribution of the firm. Value added is the output of a firm minus all input that it buy from other firms. In order to clear the concept of value added, here is the chart. So there are so many stages of the production, you can say production stages, and selling price, intermediate good, and the value added, net income. For example, farmer sells wheat. First stage, farmer sells wheat, and the selling price is 100 rupees. There is no intermediate good for the farmer, so net value added is 40. Selling price is 40 rupees, sorry, and net value added is 40. And out of that 40 rupees, farmer sells uh, the wheat worth 40 rupees to miller. So miller sells, so that for that wheat worth 40 rupees, you know, that farmer receives, will be paid by the miller, and that wheat will be converted into flour, and that FLOUR, okay, there is mistake, printing mistake. So a miller sells that flour to baker at 55 rupees. So for miller, 40 rupees is the input because he purchased wheat from the farmer at 40 rupees. So and by using that wheat, it converted it to flour and it's sold to baker at 55 rupees. So what is the difference? This is 15 rupees. So baker uses the flour, okay, and makes bread and sells bread, okay. Baker sells bread at 100 rupees, and for baker, flour cost is 55 rupees, which baker has paid as intermediate good. So the difference between these two headings is 45 rupees. And the bread total production cost of the bread is 100 rupees. So that baker sells bread to dealer at 150 rupees and dealer has paid 100 rupees for this bread, okay. So 120 minus 100 is equal to 20, and finally dealer sells retailer to the entire breads, okay. The value is at the price 140 rupees. Retailer, okay, dealer sells bread at 100 rupees, okay, and dealer purchase uh, bread, dealer sells bread at 120 rupees, sorry, and dealer purchase the bread from baker 100 rupees. The difference is 20. Now the dealer, now retailer gets the bread from the dealer by paying 120 rupees. So this is 120 rupees, and that bread will be sold by the retailer to the customer, final customer at 140 rupees. So the difference is 20. So when we see here the wheat original input of the bread wheat cost 40 rupees. Here many modifications are included, you know, and finally the wheat value of wheat is increased to 140 rupees. After increasing machineries and labor and profit and all, it becomes 140 rupees. And here what is the value added? Here in the first stage 40 rupees net input, and here value added 15. Here in the third stage 45, and fourth stage 20, and fifth stage 20. When we add all these value, we get 45, 40, only 40 rupees. So the value added, so the same amount as the final product. So but value added is more reliable, more accurate than the output method, because we cannot accurately calculate this value addition of these sectors in the practical life. So difficulties of national income accounting. There are so many difficulties of national income accounting, like problem of double counting. So here one good is produced as a intermediate good, and the same good is produced as a final good. It may be the case. For example, sugar. Sugar can be directly consumed, so sugar becomes final goods. If sugar is added on the bread, or sugar is added on the tea and coffee or sweets, so it becomes intermediate goods. So there will be some confusion to get to the uh, actual value of the sugar. So due to the double, not only double, many stages are there. So here we wrote problem of double counting, manifold counting, you can say. Problem of statistical data. So the economy needs a very sophisticated uh, data system to calculate this income accurately, but it is very difficult to accurately calculate the national income due to the problem of sophisticated mechanism to calculate net income. So capital gains or losses. We cannot include capital gains and losses properly, because we do not, the government, you can say the government system may lack to account for capital gain, sudden gains. A person gets some money out of gambling, or some money out of lotteries, or some gift, that is the capital gain. So it is very difficult to receive the information of the capital gains, and sometimes capital losses in the businesses, gambling losses in some businesses, lottery payment on the lotteries, and so many capital gain and losses would occur in the society, which is very difficult to account. Next, income from illegal activity. People earn money from illegal activity that will not be included in the national income, but in real life, people, some percentage of the people may get money out of illegal activity. So they get money out of illegal activity, and that is the income of household sector. Okay, household sector has income illegally, and definitely they create demand in the society. But there is no equality in the income side and expenditure side. Okay, so this is the problem. If people earn money from the illegal activities, their income does not show its counterpart. Okay, that means uh, income, household sector's income will be added due to illegal activities. Household sector may create demand, but that counterpart may not reflect on the output side or expenditure side. That will be a problem. Non-monetized economy. Economy is still not monetized in especially in the developing countries. Still people want pay in cash. Okay, not through banking channels. Okay, so in such cases, the payment in cash or payment in kind does not reflect the net income accounting accurately. So non-monetized economy may have problem of accounting net income accurately. Illiteracy and ignorance. People, they do not have idea, due to ignorance, they are uneducated, illiterate, so they may do their own job, that, but how much money is contributed, how much amount is contributed by their own self job, that is not properly recorded. So due to the illiteracy, due to ignorance, so people in a community, they have they may do many jobs, for their own sake, on their own, that will not be accounted properly in the net income system, accounting system. Inventory valuation. So there is some changes in the inventory goods, like previous year some input has been purchased and kept as a stock, and this year the price of inventory has been increased. So definitely the value of inventory changes may increase this year's current year's net income, but that is not the actual way of calculating net income. Fluctuations in the money value and prices due to changes in the money value that we discussed in the previous slides, like the price changes. 2000 orange may become 3000, but that is not the actual contribution in the economy. This is due to the fluxes in the prices, due to changes in the prices. So that is not the actual net income accounting. So these are the various problems of accounting net income. Although there are so many problems of accounting net income, we need to calculate net income in order to show the strength of the economy, health of the economy, living standard of the people, in order to compare the economic standard, economic status of the country, and so on. So there are so many positive aspects of net income accounting. So all the countries in the world, they give emphasis on the accurate calculation of net income accounting. With this, I would like to conclude this video. I hope you understood me. Please share and subscribe. Thank you very much. Have a good day.